We had a very exciting week in the markets, as everybody knows. The stock market all over the place. And Wall Street is full of euphemisms. One of them is volatility, when what we mean is that you lost your shirt. And this week was truly volatile, up and down and up and down and up and down and up and down, finished up today in the sense of the stock market. Maybe the most important single thing to take away is the upset in the markets this week was not an isolated event, nor was it an aftershock. Most likely it is a foreshock of more to come. The second most important takeaway is the shock is the outward ripples, as I wrote nearby, the carom of balls all over the place that follows when you break a pool table. The source of the upset was in Europe. The European economy is rolling over. The deflation is at the door. The efforts of the ECB to buy time have expired. I'm sure Europe will try to find something in the next few weeks to do to buy some more time, but most likely they're enough out of time that these shocks will be more recurrent on a shorter cycle. The ECB bought almost 3 years with its promises to buy bonds if necessary, and now that's done. The impact here is, we haven't been in a situation like this since the late 1990s, in which the external world was in trouble, but we're not. In the data and in all of the panic in the stock market, there's nothing in the U.S. data pattern to suggest really anything more than the mildest slowdown after a very strong summer. There's not an acceleration either, but there's not some sign that troubles overseas have infected the U.S. economy yet. However, the deflation overseas, even though the U.S. economy is moving, and moving at a pace that might cause the Fed to raise interest rates, deflation's a real problem. And deflation itself is moving from overseas to here. Oil prices, currencies, everything, Europe, China, Japan, which means that all of a sudden, instead of rates rising with the Fed, no they're not, the Fed suddenly this week is off the table. Forget about it. Unless the data pattern changes enormously overseas, the Fed's off the table, not just for the rest of this year, but it's off for 2015, maybe off for 2016, and who knows how long. The only thing that would bring the Fed back into the picture would be sudden, very strong wage growth in the United States, and even that might not do it. There's a pretty good chance that U.S. rates, mortgage rates, fall, that we drop down into the 3s. We have not. We're still above 4. I wouldn't wait to lock, wait to do a refinance, wait to do anything, because there's no predicting when such a thing may take place. But there's every reason to think that rates here will revisit the all-time lows of 18 months ago. Good weekend.